Are you ready? I don't think you're ready. Get your popcorn, get yourself a soda or something else that you want to drink, because I'm going to share with you something that should have been shared with you a long time ago. And that is how life insurance really works. This is not a sales pitch. This is not me trying to get you to buy this or buy that. This is strictly educational. Now, I hope what comes from it is, one, you like this video. Two, you subscribe to our channel. Three, you comment below and let me help you do an analysis on what you've got. And then four, you share this with other people that you love and you care for so that they can get access to this as well. This is, for the better part of over 20 years, this is kind of what I've been doing and helping people with. And it amazes me that it's still kind of this taboo thing and it's got this negative connotation to it. Life insurance is one of the most misunderstood financial vehicles, products, solutions out there in the marketplace. So this is a quick 10-minute lesson on life insurance, how it works. And I want you to rethink the way that you think about life insurance, because it could change your life and change the financials for the rest of your family's existence. So here's what we know, and I'll go back. There is a minimum amount. So we're going to talk about a $500,000 life insurance policy for right now. There's a minimum amount that can be paid into the life insurance policy. And then there's a maximum amount that can be paid into the life insurance policy. The minimum amount is what we know as term insurance, and that's set by the insurance industry. The insurance industry, they set the term insurance limits, the minimum premium that they're willing to accept for a $500,000 life insurance, depending on your age, your gender, so on and so forth. But the federal government, they're the ones that set the limit on what's the maximum that can go into a life insurance policy. For those of you that have been around for a little while, anytime the federal government gets involved, do you think that they're getting involved to limit the bad things for us, or they're getting involved to limit the things that are really good that work well for us? Something to consider and think about. In between the bottom amount, the term insurance limit, and the top limit of premiums, the minimum and the maximum, there is an infinite number of product designs. And I've already started to kind of share this with you in previous videos. And you can look at either this one, or I don't know where it's going to show up on the screen, but click that link and then come back to this if you want, or make a note. We'll put a card up at the end of this video so you can click on some of our other videos. But we're already starting this discussion about infinite product design. Now, here's a little history lesson of what took place in the 1980s. There was a tax law change that got written in called the TEFRA tax law that came into effect. And it basically created qualified plans, or in other words, it was the extinction level event for pension plans or defined benefit plans. We all know our grandparents or others that said, well, you work at a company for 35 years, they give you a pension plus your Social Security and you're retired. Well, those days are long gone because of this tax law change that came into effect in the 1980s, early 1980s. It created the individual retirement accounts, the 401k plans. 401ks were not around in the 70s. That is a direct result of this tax law, TEFRA, SEP IRAs, 403bs in the nonprofit world. But give me a little bit of leeway. Let me kind of give you guys a little lesson on qualified plans. They do two things. They defer the tax and the tax calculation. But instead of saying defer tax, we should change that word to postpone. The government is patient, for the most part. They're patient, and they're willing to wait because they know in a qualified plan, if they think about planting seeds versus harvest, they're willing to postpone taxing you on the seeds so that they can tax you on the harvest. And what they're also planning on is the taxes will be different. Now, when I ask people this that have not been through my classes or have not had conversations with me, I said, what tax bracket are you going to be in retirement? And they come back with, well, John, I'm going to be in a lower tax bracket. I'm like, well, how do you know that? How do you know for a fact you're going to be in a lower tax bracket than where you are today? Because the second question you have to ask yourself is, what deductions will you have at that time? Will you have the child care or the child tax credit? No. Will you be able to write off the interest on your mortgage? Nope, because that's probably going to be paid for. Are you going to be able to take itemized deductions? Probably not, because you're retired and you're not working anymore. So what deductions will you have? And when we look at what the tax thresholds are, we go down to 2023, and this is for an individual, the initial rate is 10%, but the maximum rate is 37%. There's lots of brackets between 10 and 37%. And if I go back a little bit further, if I go back to the early to mid 90s, the lowest bracket was 15%, while the highest bracket was now 39%. Okay, let's go back a little bit further. Let's go back to, 1966, the highest bracket was 70%. I see a 75 and 68. 77 and 69. But highest bracket was 70%, but the lowest bracket was 14%. But that was at $1,000 of initial earnings. So the government is messing with when they start to tax you. And do I dare even show you what happened in the late 50s, early 60s? Look at what that top tax bracket is, 91%, but 20% at 4,000. Now that's adjusted for inflation, but I promise you, it's not a whole lot different than the 22,000 we are today at 4,000 then and 10%. So very quickly, your lowest tax bracket could get doubled. It could go to 10%, 20%, 25% at the snap of a finger. It just takes government to interact with themselves and to change that. Because here's the historical lesson of that. If you look at graphs and charts like I do, look, there's a valley, peak, valley, peak. Is this the valley right here? Are we as low as it's going to get? Could you think it could possibly get lower given where we're at and what we have to pay for? Because let me share with you this. Have you seen this? This is the national debt. And I want you to focus on the US national debt of $34 trillion. And I remember doing a video, you can go back into our archives of YouTube videos, not so far back, just December, where I was talking about how the national debt was just now crossing over $34 trillion. Fast forward 5 months later, we're already closer to $35 trillion than we are $34 trillion. But here's what I want to show you. The US official spending, if I can zoom in on this, is $6.5 trillion. Okay, what's the big deal? Well, the US revenue is only $4.7 trillion. Let me put it like this to you. A $6.5 trillion expense is like you and your family living on $65,000 a year, but only making $47,000 a year. That other $18,000 a year that you're spending is going on credit cards. And that's exactly what's happening with the federal government, except it's not $18,000, it's not $180,000, it's $1.8 trillion a year that the federal government is overspending relative to the income that they're bringing in. And that has to do with the Social Security liability, the Medicare liability, the US unfunded liabilities down here, but I digress. The point is, it's $1.8 trillion of deficit. How do you think the federal government is going to improve upon that deficit? Do you think they're going to spend less, or do you think they're going to tax us more? Okay, well, let's go back to that. So if they're going to tax us more, and right now our lowest bracket's in 10%, do you think your lowest bracket could become 20%, 30%, 40%? By the way, the average of the top tax brackets is 56, almost 57% since over the last 100 plus years. And on a $100,000 balance, you postponed taxation of the seeds so they could tax you on the harvest. At what rate? You don't know. That's the bet you took with the government. So I'll go back to this. Okay, that's why life insurance can be so important, because when we structure this properly and we stay underneath the level of the what's called the modified endowment contract, and we fund the policy to its maximum possible potential. And again, we do this two ways. We see what you're wanting to fund it, and we put the smallest policy on top of that, or you find the policy and you fund it up to that level. But inside of that, we're trying to take advantage of features and benefits. Tell me which one of these you don't want. Tax-deferred growth, tax-free distributions, competitive rates of return and growth on your money, high contribution limits where you don't get phased out like you do in IRAs, 401ks, Roth IRAs, phase out limits for income. You don't have that problem with life insurance. Additional benefits like long-term care, living benefits, disability benefits, things like that. Collateral opportunities where you can use this asset as a collateral for another loan. They're safe, they're guaranteed, they have no loss provisions. You're guaranteed to be able to borrow money from it without regard for your financial position. Try going to a bank when you don't have a job and you don't have any income coming in, and go try to borrow money from a bank. But if you've done the prudent thing and built money up inside of your life insurance plan, you can borrow money from it whenever you want to, and you can pay it back with unstructured loan payments. You can pay it back whenever you want to. You can even possibly pay it back at death if you wanted to, but you can't do that at a bank. And it gives you liquidity, use, and control when you structure this life insurance properly. Oh, and it would be really good if we could get deductible contributions, but I'll come back to that here in a second. So the minimum line is term insurance. The maximum line that the government sets, which, because now you see all of the positive things that life insurance can provide for you, the features of life insurance, forget about the death benefit for a second, but all of the positive features that life insurance can provide for you. It's no wonder that the federal government puts limitations on that, because you would never put another dollar into your qualified plans, and they would never be able to tax you on the harvest because you would be being prudent with your money. So what do? They cap you off. They put this smear campaign, I guess what you can call it, or they get unprofessional people out there. Anybody can get a life insurance license. And so we're just going to cannibalize ourselves. We're going to sell you bad product, and everybody's going to hate life insurance. And then Dave Ramsey's going to win, right? But you got to do this the right way, because when done the right way, term insurance takes care of the death benefits. But inside of the permanent life insurance structure, watch what happens when I move this up. When we fund life insurance, all the way up to the government allowed line of a modified endowment contract for a life insurance policy, we are getting every single one of these features and benefits that we can possibly get, except for one: deductible contributions. Okay, fine. We don't get deductible contributions. Well, that's fine. I don't get deductible or you don't get deductible contributions in your Roth IRA, but everybody wants a Roth IRA. This is like a Roth IRA on steroids when funded properly, and it can be cheaper and more efficient than a traditional brokerage account. You need to watch that video, either this link or this link. Watch that video I did last time on how a properly structured, well-funded life insurance policy can be cheaper than a traditional investment account after the capital gains taxes, the dividend taxes, and the 1% management fee that gets charged. This is the most misunderstood vehicle, because too many of the people that have a license like I have just trying to sell it. This is what they do. They're trying to sell you a $500,000 policy and only have you funded at a very low level so they can make a commission. But the reality is it needs to be funded for maximum efficient growth. This is a maximum efficient contract. And I really do appreciate the fact that people are starting to reach out to me. In fact, another person just reached out to me, shot me 2 PDFs of their existing policies because they want to know if they got taken advantage of and they're funding it the right way. And I got to be honest with you, before I hit record on this video, I looked at it and it's not funded as well as it could be. Now, it's funded better than the one I showed you prior, but this one is still underfunded. And I may do a video on that one as well, just to kind of show you. It's hard, man. You guys don't know who to trust. Comment below, reach out to me, like, comment, and share. I hope this was helpful for you. Reach out to me because we can take advantage of the tax law. The government set the tax law up for life insurance to be one of the best tax havens that exist. And it's one of the most misunderstood ones that people take advantage of. I'll see you in the next video. Be safe.